macro currency signals.
Something changed, and most people didn't notice it when it happened. They were watching daily price swings. They were staring at headlines. They were reacting to noise. But the real signal didn't happen in a single candle. It didn't flash on a news alert. It happened quietly, structurally. And once you see it, you can't unsee it. Silver didn't just go up. It shifted regimes. For years, silver moved inside a psychological cage. It surged. It corrected. It teased breakouts. And then it fell back into line. Traders learned to treat it like a volatile cousin of gold. Investors learned to temper expectations. Analysts labeled it overbought every time it ran, and the cycle repeated. But this time, the breakout didn't occur in isolation. It didn't occur on the price chart alone. It occurred in the relationship, the spread between silver and gold. That's the part almost nobody watches. Before we dive deeper, if this analysis is hitting the way it should, make sure you're subscribed and have alerts turned on. In shifts like this, being early isn't optional. It's everything. Jump into the comments and let me know where you're watching from and what time it is where you are. This isn't a local discussion, it's global. And seeing how far this message travels always says more than any headline ever could. All right, now let's get back to what just unfolded. When you divide the price of silver by the price of gold and you step back 10 years, you see a ceiling. Not dramatic, not flashy, but firm. Every attempt to outperform beyond that level failed. Every time silver tried to assert itself relative to gold, it stalled. And then it didn't. In November, that ceiling broke. On a closing basis, that is not a minor event. When silver breaks out versus gold, history shows that something different unfolds. It's not a slow grind. It's not incremental appreciation. It's repricing, and repricing happens fast. We've seen this structure before, and every time it appeared, it preceded a vertical move that compressed years of expected gains into months. This isn't about hype, it's about pattern recognition. December became month 1, January became month 2. February, where we stand now, is still early in a potential 2-quarter acceleration window. But here's where small silver holders need to pay attention. Acceleration phases are volatile, they are emotional, they shake confidence before they reward conviction. Already we've seen 10% to 12% intraday collapses, sharp drops within hours, the kind that make you question everything, the kind that make commentators shout, top, the kind that trigger weak hands, and yet zoom out. Last month closed massively higher than the month before. This month is closing dramatically above the previous quarter. The volatility isn't exhaustion, it's ignition. When a market transitions from accumulation to repricing, volatility expands. It has to, because the market is recalibrating value. Old anchors no longer apply. Old norms get discarded. Oscillators scream overbought, and the price keeps climbing anyway. Analysts call for pullbacks. They come, but shallow and brief, before the next surge. And somewhere in the middle of this acceleration window, there will likely be a midpoint correction. Not the end, a midpoint. History shows it doesn't arrive politely. It doesn't last a day. It lingers. It frustrates. It convinces people the move is over. It stalls momentum long enough for doubt to spread. And then the second leg begins. What matters most right now isn't the exact day of that correction. It's understanding what side of the structural shift we're on. Because silver isn't moving in isolation. It's responding to something much bigger, something deeper, something systemic. The global sovereign debt structure is under stress, not hypothetically, not years from now. Now, long-term government bond yields have been elevated for years, despite rate cuts, despite liquidity operations, despite verbal reassurances. The long end hasn't stabilized. It has hovered at stress levels. And if bond prices slip just a few more points, technically speaking, it could trigger a recognition event. Recognition events are different from routine volatility. They are moments when the market collectively realizes that a foundation may not be stable. The bond market is larger than the equity market. It is the collateral base of the global financial system. If long-term government bonds are perceived as unstable, portfolio models shift, institutional allocations shift, risk perceptions shift. And when that happens, capital seeks monetary neutrality. Gold understands this first. Silver follows. But when it follows after a relative breakout, it doesn't crawl. It runs. The reason this matters for small silver holders is simple. If a sovereign bond stress event forces aggressive intervention, liquidity expansion becomes the tool of choice. And liquidity expansion erodes confidence in currency purchasing power. That environment historically fuels monetary metals. But silver has an additional dynamic. For decades, it has traded in a defined historical range. It would spike, it would collapse, it would return to its band. 50 years of psychological containment. But ranges eventually break. Other commodities have done this before. They traded within defined ceilings for decades. Then they broke out and repriced in quarters, not years. They didn't gently migrate higher. They jumped into new realities. Silver is showing early signs of that same behavior. That does not mean straight up. It means compressed movement, violent swings, emotional tests. And this is where many small holders sabotage themselves. They attempt to finesse the midpoint correction. They sell core holdings expecting to buy lower. They watch it dip. They hesitate. It reverses. They chase. Or worse, they never get back in. The first leg builds belief. The midpoint builds doubt. The second leg builds disbelief. Right now, we are still in belief territory. The bond market is dancing on fragile ground. Yields remain elevated. Intervention hasn't restored confidence, and the metals are reacting not to daily data releases, but to structural risk. That is why applying old metrics to silver right now can be dangerous. This is not a typical overbought rally. It is a structural repricing attempt. If the long bond breaks key support and panic responses emerge, the next liquidity wave could ignite the second leg of this silver move faster than most expect. And remember, in prior historical accelerations, what followed the midpoint correction was larger than what came before it. That doesn't guarantee repetition, but it establishes precedent. So, what should small silver holders be thinking about in February 2026? Not the daily noise, not the hourly collapse, not the talking heads. They should be asking, has the structural shift reversed? Right now, the answer appears to be no. The relative breakout versus gold remains intact. Monthly momentum remains elevated. Macro stress in sovereign debt markets remains unresolved. Volatility is expanding, but in a pattern consistent with ignition, not exhaustion. That does not mean complacency, it means clarity. If you hold physical metal as insurance against systemic instability, you don't trade the insurance policy during the storm. If you are leveraged, that's a different conversation. Leverage requires discipline. But core holdings, during a structural repricing phase, demand patience. Because if the bond market slips those final technical levels, the response won't be subtle. And markets front-run responses. Gold is already leaning into that reality. Silver has just stepped out of its long shadow. February is not the end of the move. It may still be the early chapters. And if a midpoint correction arrives, it will test conviction, not invalidate structure. Small silver holders need to understand that volatility is not the enemy during regime change. Misreading volatility is. We are in a window where months matter more than days, where structural shifts matter more than sentiment polls, where the long bond may dictate the next acceleration in metals. The clock started when the relative breakout occurred. We are only a few months in. And if sovereign stress intensifies, the second leg of this move could be faster, louder, and more dramatic than the first. Stay steady, watch structure, ignore noise. This isn't about chasing price. It's about recognizing regime change before the crowd does. Now let's go deeper, because what's happening in silver right now is not just a technical breakout and not just a bond market story. It's a psychological shift layered on top of a structural imbalance. And when those two forces collide, price doesn't move politely. It moves decisively. Most small silver holders think in straight lines. If silver rises quickly, they assume it must fall quickly. If it stalls, they assume it's over. If it drops hard intraday, they assume something broke. That mindset works in range-bound markets. It does not work in repricing markets. Repricing markets behave differently because they are not searching for a marginal buyer. They are searching for a new equilibrium. For decades, silver lived inside an old reality. It oscillated within broad boundaries, occasionally spiking on speculation or fear, then retreating once pressure faded. The ceiling felt permanent. The floor felt reliable. Traders built entire careers fading extremes, but old realities break when underlying fundamentals no longer support the containment. Here's what most people overlook. Silver is not just a monetary metal. It is also an industrial metal embedded in modern infrastructure. Every expansion in electrification, renewable energy systems, grid upgrades, data centers, and advanced electronics pulls silver into long-term consumption cycles. Unlike gold, much of that silver is not sitting in vaults waiting to be resold. It gets dispersed. It gets used. It becomes economically impractical to recycle at small scales. So, while monetary demand is rising because of sovereign stress, industrial demand has not disappeared. That combination tightens supply conditions beneath the surface. Now layer that on top of something else, investor positioning. For years, large capital pools ignored silver. It was considered too volatile, too small, too chaotic compared to gold. Allocations were minimal. That created a peculiar dynamic. When capital finally decides it needs exposure, the market depth isn't enormous. Silver's market is much smaller than gold's. That means when allocation shifts even modestly, price moves disproportionately. You don't need trillions flowing in, you need incremental reallocation. And this is where the bond market stress feeds the narrative. If long-duration government bonds continue to lose credibility as a stabilizing asset, traditional portfolio construction models get rewritten. When bonds no longer reliably hedge equity risk, asset managers search for alternatives that can act as systemic hedges. Gold is the obvious candidate. Silver becomes the high beta extension of that thesis. But here's where psychology becomes explosive. Once silver begins to outperform gold, and that relative breakout holds, momentum-driven capital pays attention. Not because of ideology, not because of fear, because performance demands it. Performance attracts attention. Attention attracts flows. Flows move price. Rising price reinforces performance. That feedback loop is powerful in compressed windows. Now let's address the midpoint correction again, because it will likely come. And when it does, it will feel convincing. You may see weeks where silver cannot make a new high. You may see sharp downside spikes that retrace 15% or more. You may hear narratives about demand slowing, about industrial weakness, about speculative froth. That midpoint stall is not designed to reward comfort. It is designed to test resolve. Historically, the midpoint does something important. It resets leverage. It shakes out weak hands. It forces late momentum chasers to capitulate. It cools sentiment just enough so that the second leg can build without immediate exhaustion. If you study prior acceleration phases, you'll notice something consistent. The first leg builds curiosity. The midpoint builds skepticism. The second leg builds mania. We are nowhere near mania. Retail participation remains cautious. Mainstream commentary remains skeptical. Institutional allocations remain modest relative to overall portfolios. That matters. True blow-off tops require widespread euphoria and overexposure. We are not there. What we are seeing instead is structural repositioning under the surface while public narrative lags. Another key factor small holders must understand is currency purchasing power decay. This isn't dramatic hyperinflation talk. It's long-term erosion. When central banks respond to bond stress with liquidity support, they are effectively defending sovereign credit markets by expanding balance sheets. That doesn't immediately show up as runaway consumer inflation every time, but it does gradually debase purchasing power over cycles. Monetary metals price that erosion over time. Silver, because it has lagged for decades compared to gold, carries additional catch-up potential during these phases. And let's talk about ratios for a moment. Not specific numbers, but structural meaning. When silver begins closing the gap relative to gold after years of underperformance, it signals that the market is repricing monetary risk tolerance. It signals a willingness to move further out on the volatility spectrum in pursuit of protection. That is not a small shift. It's a behavioral one. Small holders often underestimate the importance of behavioral transitions. Markets don't move only on fundamentals. They move on shifts in collective belief. Right now, belief is shifting from bonds are stable to bonds are fragile, from silver is speculative to silver is strategic. Those shifts take time to be accepted publicly, but price begins adjusting before consensus catches up. Now, consider something else: fiscal trajectories. Government debt levels across major economies are historically elevated. Interest expense as a percentage of tax revenue has climbed. If long-term yields remain elevated, refinancing becomes more expensive. That creates pressure either for fiscal tightening, which is politically difficult, or monetary accommodation. Monetary accommodation tends to benefit hard assets over time. If markets sense that tightening cannot be sustained without destabilizing debt markets, they begin pricing future accommodation in advance. That anticipation alone can fuel precious metals. So when you combine industrial demand firmness, constrained above-ground supply, institutional underallocation, sovereign debt stress, and relative breakout technical signals, you create a rare alignment. Rare alignments don't happen often. And when they do, they tend to resolve decisively. But decisively does not mean smoothly. Volatility will increase as price rises. Daily ranges will expand. Headlines will exaggerate every pullback. Commentators will call tops repeatedly. Small holders must prepare mentally for that environment. The greatest mistake during acceleration phases is confusing volatility with failure. Volatility is the mechanism by which markets transfer assets from weak hands to strong hands. If you are holding physical silver as a long-term monetary hedge, your framework must differ from that of a leveraged trader. Ask yourself, has the structural thesis changed? Has the sovereign debt burden shrunk meaningfully? No. Have long-term bond yields returned to stable, low levels? No. Has silver's relative breakout reversed and fallen back below its prior ceiling? Not at this stage. Until those structural conditions change, volatility alone does not invalidate the thesis. Now, let's look ahead. If the bond market does experience a sharper sell-off, even briefly, and central banks respond with aggressive stabilization efforts, markets will interpret that as confirmation that debt markets cannot self-correct without intervention. That perception accelerates capital rotation into monetary hedges. And because silver's market depth is thinner than gold's, price response can be exaggerated to the upside. That is how you get vertical segments. But vertical segments do not last forever. Eventually, price overshoots. Eventually, sentiment overheats. Eventually, you approach a phase where caution becomes necessary. We are not there yet. We are still in early to mid-acceleration territory. February 2026 is not about predicting the exact high. It is about recognizing the phase we are in. Small silver holders must avoid two extremes: blind euphoria and premature pessimism. Blind euphoria leads to over-leveraging and emotional decision-making. Premature pessimism leads to exiting core positions during structural repricing. The middle path is disciplined conviction. Understand why you hold silver. If it is insurance against monetary instability, then short-term volatility should not dictate long-term positioning. If it is a speculative allocation, then manage risk consciously. But don't confuse noise for regime change. Watch the bond market. Watch long-term yields. Watch central bank balance sheet behavior. Watch the silver to gold relationship. Those indicators matter more than daily price spikes. There will be days when silver drops sharply intraday and closes strong. There will be weeks where it churns sideways. There will be sudden surges that feel unreal. All of that fits inside acceleration phases. What would invalidate this thesis? A sustained breakdown in the silver to gold ratio back below its breakout level. A meaningful restoration of bond market stability without liquidity expansion. A decisive contraction in industrial demand without monetary offset. Those are structural reversals. We are not seeing them at this time. Instead, we are seeing stress in sovereign debt markets, elevated long-end yields, and persistent allocation discussions about reducing bond exposure in favor of hard assets. That backdrop supports continued volatility with upward bias. So as we move deeper into 2026, the question is not, is silver overbought today? The question is, has the regime shifted? Right now, evidence suggests yes. And regime shifts are not reversed by a few sharp pullbacks. They end when structural imbalances resolve, and sovereign debt stress has not resolved. Small silver holders need mental endurance more than predictive precision. You do not need to forecast every dip. You need to understand the environment. Acceleration windows compress time. Months feel like years. Price ranges expand dramatically. Emotional intensity increases. But if the structural forces remain aligned, the second leg, after the inevitable midpoint correction, can be more dramatic than the first. Stay alert, stay rational, stay grounded in structure rather than noise, because what is unfolding in silver right now is not just another rally, it is potentially the transition from an old monetary reality into a new one. And transitions are never quiet. They are volatile, they are uncomfortable, they are transformative. Understanding that, truly understanding it, may be the most valuable edge a small silver holder can have in February 2026. If you hold silver, hold it with clarity, not fear, not greed, clarity. We are in a period where sovereign debt stress, bond market fragility, and monetary response mechanisms are converging. Silver has broken out relative to gold. Volatility is expanding. The clock that started months ago is still ticking. There may be a midpoint stall, there may be sharp pullbacks, but structural shifts do not reverse easily. Watch the bond market, watch liquidity, watch the ratio, ignore the daily noise. Because if this regime change continues unfolding, what feels volatile today may look early in hindsight. Stay disciplined, stay informed, and above all, understand the phase we are in.